Welcome back in YouTube. So in this video, it's going to be very quick. A lot of my favorite stocks are really starting to move here, and specifically I want to talk about one that got away from me. And that's going to be Chuy's Mexican Restaurant. This is my wife's and I's favorite restaurant. I started diving into the fundamentals on this stock. It was very interesting actually. To me, it was a buy between about $20 to $26 range here, and what ended up happening? Well, the company got acquired by Darden Brands and shot from $23 a share to $37.35. Now, this is not the big problem. This company was sitting right around a $300 million market cap, now shooting over $643 million, up nearly 50% on the day because the buyout price is $37.50 per share. And my wife and I, we bought the stock at $25. And what did I do? I sold the stock, because the technicals looked bad and I was concerned about most restaurants' earnings. And fast forward a week and a half later, and they get bought out by Darden Restaurants. Of course, the wife is mad at me, definitely got yelled at, but this is part of investing. What can we learn from this? Yeah, I've done this a few different times here where I lean on the technicals and what peers' earnings are, and the fundamentals for that individual company tend to be still valuable, and they get acquired. And that's happened a few different times with me. So I think instead of selling completely out of the position is maybe downsizing a little bit if the chart's going against you and the fundamentals are starting to weaken. But as long as there's some fundamentals there and there's still some value there, I think you still have to hold a piece of it. So that's definitely a mistake that I personally made. And I've actually covered this stock in one of my videos, and anybody that's been subscribed to the channel probably knows that I've mentioned this Chuy's stock a few different times because I thought it was an interesting deep value restaurant. The thing about restaurants is low margins, high exposure to consumer, and we see the consumer slowing down. So there was good reasons for the sale. Whether it's right or wrong, you can't really always go off of the outcome. Even with that being said, we are starting to catch up to market returns here. And a lot of these are what we call turnaround stories. So PFIZER is a turnaround story. Warnerbros Discovery is a turnaround story. Cisco Systems is kind of dead money, but deep value. Turnaround story for Zoom, and Bumble kind of getting overlooked for the growth trajectory I think the company has. Now, because of the concentration, it's going to be a lot more volatile than the actual indexes. But what I want to show is over the last few weeks, we've definitely been getting some really nice appreciation here. And the crazy thing is I'm really relying on dividend return in this portfolio, considering that my two largest positions are Cisco, which is paying over 3.5% dividend. And when I bought PFIZER around $25 a share, it was over a 6% dividend. 35% of my market returns I thought were going to come in the form of a dividend. And now we start seeing how I'm catching up here to market returns. Since May 14th to today, I'm at 5.35%, which is behind the Russell a few percentage points, catching up to the S&P, which is at 7.3%, and beating the Dow Jones. Obviously, very behind the NASDAQ because, let's just be honest, if you didn't have NVIDIA or any of the major chip makers in your portfolio, you're probably underperforming both the S&P and the NASDAQ. And so the reason why I like looking at returns here is because if you're not beating the market and you're taking so much time out of your day, it doesn't make sense to buy individual stocks. And so as most of you know, for PFIZER, right around that $24, $25 mark with earnings troughing, I thought it was a really interesting buy as long as they can keep the dividend intact. And actually, I'm okay with them getting rid of the dividend to buy more biotech companies and build out their pipeline, but that's just me personally because I think the total returns would be much higher. But in this video, I specifically want to talk through WarnerBros Discovery. This was a deeply depressed asset that still has some decent fundamentals underneath it. This is definitely a company with great brands and incredible content, heavy debt load, and questions about the future and streaming, as streaming has definitely been a headache, and Netflix is ahead of this game and everybody thinks Netflix is going to win. But I think this is just the beginning of the story, and it's anybody's game to win. And I honestly think looking at some of the content and partnerships is where you want to look at. And the fact that Warner Brothers Discovery is partnering with Disney and they have a tremendous amount of undervalued assets in their portfolio made this one a little harder to really find the value of. But I thought it was deeply undervalued here. And so we can see over the last 5 days, this stock has skyrocketed over 16%. Most analyst price targets has this between $10 and $12 with a majority at a buy holding. Now, if you're new to the channel, we focus mainly on fundamental analysis and long-term price action. And so we really dive into the numbers and figure out what kind of assets are being really overlooked by the market, more contrarian type investment for me personally. I think once mainstream media has a hold of it and retail is starting to dive into it, the price is probably priced to perfection at that point. And so I tend to look more contrarian, and that's why we're talking about companies like Chewy's that just got bought out. We're talking about companies like PFIZER, which nobody want to own at $25. We talk about Warner Brothers Discovery that just completely fell off of a cliff. And so yes, these are a little bit more higher risk, higher rewards, but if it's companies you can kind of stay on top of the financials, if you have the time to do that, I think you can outperform the market. Very, very hard, very, very difficult. I don't recommend doing that. But what's going on here is Warner Brothers is looking to split up its assets, looking to break up its streaming and studio business from the linear networks to energize falling stock price. So they're trying to spin off these businesses, probably help reduce the debt load, and selling some assets here. The one thing I will say is the debt load seems to be under control with Warner Bros. Discovery. They have been paying it down, and I think it's getting to a point of manageability to where we have to actually start looking at the stock price appreciating even without the spinoff, and it recently got an upgrade. And so as I'm talking here, the market is still pushing higher, and as I stated before, I'm expecting the majority of my returns to come from dividends from both Cisco Systems and PFIZER. Those are my two largest holdings. We're going to go over in the next video. We're going to focus more on our watch list and really adding some more deeper value stocks that may be selling off right now, maybe being overlooked. So make sure you like and subscribe, and we will see you in the next one, guys.